the things we learn is that you typically see a dramatic acceleration in populism in the foreturning. You typically see a dramatic sort of sharpening of elbows when it comes to geopolitical and economic cooperation around the world. That obviously is quite inflationary. And so as a function of that, and the growth of federal debt as a function of the populism and the crisis itself, which are two separate phenomenon, you typically have a significant amount of financial repression and monetary debasement. I also believe there is a level of dynamism in the U.S. economy that is just, for, a variety of reasons, regulation, demographics, the general mood of the people living there. They don't have the same level of dynamism that we have here in the U.S. So the U.S. has been resilient.
Darius, it's so good to see you.
It's great to see you, man. I appreciate
I,
you. Thanks for inviting me on the show.
we had a very good conference we attended, and
Yes, we
maybe we'll
did.
talk a little bit about what we saw in the conference later.
Absolutely.
Um, Last time we spoke, and I recommend everybody take a look at our previous interview. You went through all of the details of how you do your work
Yep.
that leads to what I have worked with many strategists. Very few take the time to make specific predictions and go at the risk that you go at when you are making predictions about the regimes that we're moving in between to determine whether certain markets are in structural bull markets or structural bear markets, and sector by sector. And so I want to definitely touch on that, and probably will do that first. But I would do want to also spend some time thinking about a little bit longer term.
Oh yeah.
What are the big issues facing us today for our economy, global economy, how it all interacts, and what the likelihood is as the inevitable problems start to unfold from the core of what you do, which is pay attention to what the policy response is to those issues that look so dangerous to
Oh yeah.
us immediately. So why don't we start with the near term? Tell us what you're thinking, and it's great to see you again.
Bob, I appreciate you having me in. Like I said, thank you for having me. So I'll give you guys a quick rundown on how we view the world here at 42 Macro. It's quite a bit different than your sort of, I guess, your average macro strategist. And I don't mean that pejoratively. I just mean it is different, and we're very grateful that it is different because it's been working for many years, for almost 5 years now for our clients. Really grateful for that. And then we'll back up and talk about the longer term perspectives that we share with some others. Most notably and most recently, Paul Tudor Jones is actually out today, making some of the same waves as it relates to the U.S.'s fiscal situation and the ultimate policy response. So let me, if you don't mind, let me share my screen real quick,
Please
and we
do,
can kind
yeah.
of quickly walk through our investment process. Kind of how we think about the world here at 42 Macro, because I do think that will help investors, listeners, understand how we fit all these very complicated, economic and geopolitical dynamics into a coherent investment strategy. Because at the end of the day, what we're trying to do here for our clients is help them make money and get them closer to retirement, or get their clients closer to retirement. And so that's why we exist here at 42 Macro. So the most important thing we do for our clients that creates the maximum amount of value is that we help them identify and position for the market regime. We don't tell the market what it needs to do. We don't formulate a thesis and then put a bunch of positions on in accordance with that thesis or theses. What we do is respect the evolution of what the market is trying to price in, and we participate it. And those trends typically last anywhere between 3 to 6 months on average. But again, there's nothing average about financial markets. Everything else we say everything we're going to be talking about, most of the things we talk about in this presentation today, everything else we do when we talk about growth, inflation, policy, liquidity, fiscal policy, monetary policy, all that extra stuff, all the extra work that we're doing, that we're widely recognized across global Wall Street for producing, all that research is merely designed to help our clients emotionally prepare for regime change, so that when regime change occurs, you're comfortable making the appropriate asset allocation and portfolio construction pivots to remain on the right side of market risk. Now, Bob, as you know, and as you said, you sort of alluded to this, an investor does not have to remain on the right side of market risk. That is a choice. It is a choice to compound returns and make money. You can have a choice to be more focused on your thesis and suffering drawdowns as a function of disrespecting what the market is currently trying to price in. But again, that's a choice we are choosing not to make here at 42 Macro, and our clients have benefited tremendously before that.
Absolutely. So I know that you've written about China recently because things are changing rapidly there. How do the developments today factor into your thinking about the near term?
Yeah, absolutely. So put my screen back up again. So we are currently in a Goldilocks market regime. going back to this process. So Goldilocks is a situation where investors are generally going to want to overweight risk assets relative to defensive assets, going to overweight high beta relative to low beta, overweight cyclicals relative to defensives, overweight growth relative to value, small and mid caps relative to large caps, US relative to international, EM relative to DM, spread products in the fixed income market relative to treasuries. If you're in the treasury market, which we would advise you not to be, and have been advising investors not to be since we pivoted to Goldilocks a little over a month ago, 5 weeks ago, short rates tend to outperform bellies, which tend to outperform long rates in the treasury market. High yield tends to outperform investment grade in the credit market. The more speculative commodities tend to outperform the more sort of stable commodities in the commodity space. And then finally, gold tends to outperform foreign currencies, which tend to outperform the U.S. dollar. So our market regime nowcasting process has us in Goldilocks currently. We see reflation as the next most likely outcome, primarily driven by some of the dynamics we've been calling for here in the U.S. economy for almost 3 years now in the case of sticky inflation, and a little bit over 2 years in the case of resilient U.S. economy theme. Those two things are now combining with the market assigning a higher probability of a Trump presidency, a higher probability of a Republican-dominated Congress, and projecting the confluence of these two themes out well into the future, which is ultimately causing some volatility in the bond market. But ultimately, we do believe risk assets can survive that volatility in the bond market, at least until we get into the second quarter of next year, when things might start to get a lot less supportive for risk assets.
One of the things that's interesting is in this particular election cycle, it really seems you have a populist against a populist. Many people are saying that it's not going to matter much for markets. And that's primarily because neither of them are addressing the permanent structural deficits, and each is going about a different form of fiscal stimulus is part of their program. You're in that camp as well, I trust. I've read.
Oh yeah. Oh yeah. We've been in that camp for the better part of 15 months now, and has nothing to do with Kamala Harris or Donald Trump. It has everything to do with our views on the fourth turning. We believe, my former colleague and one of my mentors, Neil Howe, is obviously one of the authors of that framework, the geopolitical framework, which, for those who may not be familiar, one, highly recommend you go buy Neil's book. It'll help you and your family navigate what is likely to be a pretty significant crisis over the next, let's call it 8 to 10 years. And we want to make sure investors are, not investors, people, human beings are prepared for the kinds of chaos we could potentially see. But I don't say that to scare investors. I just say that to help provide them with a credible roadmap. And so one of the things we did last summer for our clients at 42 Macro was to expound upon Neil's work by adding an empirical overlay of various dynamics in the economy, various dynamics with respect to policy, and various dynamics with respect to asset markets to create a more clear roadmap specifically for investors to navigate the forward turning. And one of those things that we learned from that deep dive empirical study with data spanning hundreds of years across dozens of time series, one of the things we learned is that you typically see a dramatic acceleration in populism in the forward turning. You typically see a dramatic sort of sharpening of elbows when it comes to geopolitical and economic cooperation around the world. That obviously is quite inflationary. And so as a function of that, and the growth of federal debt as a function of the populism and the crisis itself, which are two separate phenomenon, you typically have a significant amount of financial repression and monetary debasement. And so obviously the conclusion there is you can't buy things like risk assets, gold, Bitcoin, real estate, commodities. You can't buy those things long enough. Now, we don't want you to be long those things 100% of the time, because obviously we're going to have some high volatility environments to risk manage as a function of policymakers having a missteps along this very tightrope of a walk that we have to get through over the next decade plus. But if you can generally remain long those things, you give yourself the best opportunity as an investor to survive what is likely to be some very aggressive monetary debasement, financial repression, and explosive growth in public sector debt.
This show is being brought to you by our sponsor, Trueflation. Professional investors and economists, and probably any casual observers, know that government inflation statistics are only an approximation of what real inflation is. Not only that, but the government has a conflict of interest because high inflation can be so damaging to the economy, the deficit, and our $34 trillion in debt. Trueflation collects over 13 million pricing data points. Most are updated daily to reveal inflation with precision for asset managers, governments, companies, and the general public. Check them out at trueflation.com. Well, it's a little ironic that we run these gigantic deficits structurally for at least the last half decade, and even probably stretching into a decade plus, and that
Hmm.
it's been a cushion for our economy.
Oh yeah.
It's helped our economy. Yet you look at Europe, and their structural deficits have not led to economic prosperity. Is there a clean reason for that?
Yeah, well, their economic deficit. Well, our deficits continue to grow. So it's one thing to have a deficit that's flat, that's not really contributing anything to GDP from an impulse perspective, right? It's just the same level of income, that it was in the previous year. So their deficits have not certainly kept pace in the growth rate of our deficits. I mean, recall we're adding thousands of basis points to our debt to GDP ratio every 10 years here in the United States of America. I will also say, as a
Also, in the
American
last
capitalist.
10 days, it seems, over the
Well,
charts I've seen.
I got some charts to hammer home that point in a little bit. But I also believe there is a level of dynamism in the U.S. economy that is just for variety of reasons, regulation, demographics, the general mood of the people living there. They don't have the same level of dynamism that we have here in the U.S. So the U.S. has been resilient. We've been calling for it to be resilient. In fact, we authored the resilient U.S. economy theme going back to September of 2022 and have maintained that view since then. And ultimately, we see what we're observing right now in financial markets is the last of the sort of, for lack of a better word, the last of the bear porn contingent is capitulating into that 2-year-old view. And you're starting to see that perform really well in financial markets. And we expect that to persist over the medium term, at least until we get into the second quarter of next year.
One of the other components of financial repression and debasing the currency over time is that it necessarily requires interest rates to be held below the rate of inflation.
Oh,
And
yeah.
since April of 2023, our 1 year Treasury bill rate has been above inflation rate. And so we've run, actually, ironically, a kind of tight fiscal policy, I mean, state monetary policy, while gold has achieved new highs and Bitcoin has, it's hard to know, it's probably up, but it's been so volatile, and it took off because of the ETFs. But both of them are showing strength at a time when they have a headwind, and that we know that over the next decade or two, we're going to have to hold, the US dollar regime will
Oh, yeah.
need to be holding rates below the rate of inflation.
100%.
And so are we facing this pent up release of these hard asset prices?
I think it's been going on since we pivoted back in November of last year. To be honest, I think the release is accelerating. And again, this is not going to be a linear ride to Bitcoin 1 million or gold 50,000. This we may get to those levels. I'm not saying those are actual legitimate credit. They're not credible price targets, but who knows? We may get to those levels. I actually don't know the answer. I don't think anybody knows the answer. That's the whole point of the saculum that Neil describes in the fourth turning work. It starts over again when the last people die from the previous fourth turning. You forget about the problem, and now that's kind of it. So I don't think we really truly know how this all ends, but we know how they have historically evolved in economic and policy response terms. That is what we do know, and so we can sort of overlay those insights onto our expectations for financial market prices. Bob, you said something to me that is near and dear to my heart as it relates to financial repression. So I'm going to throw a slide on the screen that is incredibly important. I want everyone to sort of to take some notes here when I say this stuff because this is a real it's a real sort of it's a good summary of what kind of the financial repression we're sort of calling for and have been experiencing and will continue to experience in our view, accelerating rates in this fourth turning, particularly no matter who wins this election, we've been arguing that we're going to see a tremendous amount more populism regardless. So whatever next sort of phase of populism we get dumped upon us from a fiscal policy perspective, it's going to necessitate that the Fed can incrementally dovish or at the bare minimum maintain its asymmetrically dovish monetary policy. So I'll start with the headline here. We are all frogs being boiled alive in a pot of monetary debasement and financial repression water due to fourth turning style fiscal dominance. So the reason we leave that is we continue to observe negative or flat term premia in the treasury market. The top panel shows the 10-year term premium in the market, which is the excess return you get as an investor for rolling over paper for the same duration. Historically, term premium in the treasury market have been around 148 basis points. So you can make the case that the combination of the size of the Fed's balance sheet, the combination of the growth of the Fed's liquidity financing facilities on the Fed's balance sheet, i.e., the decline in the reverse repo facility balance, the uptick in BTFP financing, et cetera, all the alphabet soup that the Fed has implemented in the last 15 years, including last spring to quell the decline in bank reserves. You can make the case that the asymmetrically dovish policy rate reaction function that the Fed currently has is all contributing. They're all contributing to this lack of term premia in the bond market. But what happens if we add that term premium back? What if we had a normally functioning Fed that was operating with a normal amount of monetary policy? Which, let me take a quick aside on that statement, because that is a loaded statement in of itself. If you go back and you look at Taylor rule estimates for where the Fed funds rate should be right now, we never actually even got to a level that is consistent with the kind of level that was historically, kind of got rid of inflation in the U.S. economy. So the Fed never got the Fed funds rate to a level that would have been implied by the Taylor rule as appropriate. So we have an asymmetrically dovish policy rate, very large balance sheet policy, and obviously we have some of the liquidity financing, liquidity providing features of the Fed's balance sheet moving in directions to supply liquidity and save off the decline in bank reserves. So all that has contributed to the decline of term premia from, let's say, its long-term average of 150 basis points to zero now. Well, if you add that 150 basis points back to the 10-year nominal treasury yield, instead of it, being 4.17% today, it would be 565 basis points. Well, that's very important because it ultimately means that the TIPS break-even rate, which is currently at 2.32%, is actually somewhere close to 3.8%. So, which is obviously, pricing in a much higher level of structural inflation in the U.S. But it also means that the economy is likely to be a lot more resilient than what's been signaled by the bond market over the last couple of years, which is we have a positively sloped 3-month 10-year treasury yield curve of 104 basis points wide, as opposed to a still negatively sloped 3-month 10-year treasury yield curve that's currently negative 44 basis points. So in summary, Bob, the real key takeaway here is that we are already observing pretty significant evidence of financial repression in the U.S. Treasury market. And in my opinion, that's why things like stocks and gold are up identical 36% returns ever since we started banging the table on this stuff last year. It's why Bitcoin's up almost 100% since we started banging the table on this stuff last year. And in our opinion, those trends are likely to persist over the long term.
Yeah. And even the medium and near term too.
Yeah.
Especially as the Fed continues to cut, you wind up getting that negative interest rate, which is what they need to get the dollar lower. Ironically, the dollar's actually gained value on that measure versus 1-year CPI for now 18 months in a row, which is quite surprising. I would not have thought. I would have thought that with the Fed moving interest rates as quickly as they did, that you would have had some financial accident beyond just Silicon Valley Bank.
Well, I think we did have a financial accident, and the Fed very quickly stepped in to put it out, and expanded its balance sheet to put it out. I mean, one of the most important charts.
That was the Silicon Valley Bank and the several banks that went out. Yeah, absolutely. That was the signal. I'm surprised that was it. And maybe it's because the Fed came in with a sledgehammer and made sure that the fire didn't spread.
100%. The world changed, I would argue, in the fall of 2022 with the Bank of England gilt crisis. In fact, I'll show a chart on that, and then I'll wrap up with the chart on the Silicon Valley Bank. Ignore the headlines. I'm just using this chart to explain a point. When you go back and you look at the slope of the overnight index swap curve, which are money market rates that are designed to price in the actual policy rate on a forward basis, the slope of the money market curve in the UK economy was very steeply priced, i.e., there was a lot of rate hikes priced into the forward rate curve, going back to September of 2022, when the Liz Truss government sort of, did its budget gaffe, and sort of caused a sort of a significant and dramatic sell-off in the UK gilt market. From that point, so from, whatever date that was, which is a dotted line here in this chart, the entire shape of the curve inverted and actually went negative in a span of a few months. So what that told investors around the world was that financial stability concerns, specifically the kind of fourth turning style financial repression financial stability concerns, i.e., we need to capitalize these sovereign debt markets, became the most dominant feature of forward rate curves in all these markets. We saw the same dynamic occur with the regional bank crisis here in the U.S. We had a positively sloped forward rate curve in the U.S., which went deeply negative and has been persistently negative since then. And the reason I bring that persistently negative since then up is because it had a profound impact on the liquidity supplying features of the Fed's balance sheet. This is right exactly when Silicon Bank Valley started to blow up. And as you can see, because that forward rate curve started getting negatively sloped, we started to flow a tremendous amount of liquidity out of the Fed's balance sheet into financial markets as a function of the RRP decline. And the reason the RRP decline is because investors who had parked money in money market funds in order to receive those high rates of return from the Fed's, about either the money market funds exposed the portfolio managers themselves crowded into the reverse repo facility to make their portfolios as short duration as possible. Once the forward rate curve in the U.S. started being negatively sloped as a function of the Fed's very, very dovish response to the regional banking crisis, we saw trillions of liquidity pour out of the money market, the reverse repo facility balance, and into global financial markets. And in our opinion, that process is yet to conclude. And more importantly, this entire process is indicative of the broader point we're trying to make, which is the Fed has already been backed into a corner. The Bank of England has already been backed into the corner. We would argue most of the world's major central banks have already been backed in the corner. If you consider the fact that the ECB, the Bank of Canada, the Fed, the UK, the Bank of England are all implementing dovish monetary policy with core inflation above 2%. All of these central banks have been backed into a corner that suggests that they have to do what it takes to continue to artificially produce demand for these sovereign debt securities. Otherwise, we're going to have significant problems in asset markets, and obviously that'll ultimately create significant problems in the economy.
The BRICS countries, Brazil, Russia, India, China,
Russia to Turkey. I mean, there's like 30 of them now,
Turkey.
but yeah.
There are 30 of them now. Have been they're going to have a big meeting. Is it this week?
Yeah, it's this week. Yep.
It's
21st through 24th.
And there's been a significant shift in the rhetoric at a level that most Americans don't hear about. As we look at the dollar as a reserve currency, how long before the effects might be felt, and where will they be seen?
You mean the unwind of the dollar as a reserve currency?
Or the pressures on it?
Or the pressures on it. Yeah, well, I think we're starting to feel the pressure on it. I mean, I think, to me, in my opinion, anytime the Fed has to use its balance sheet to respond to selling pressure in the Treasury market, which, by the way, it's had to do twice, once in March of 2020, another one in March of 2023. It's had to do twice in 3 years. Now, to me, I think that is very indicative of the selling pressure on the U.S. dollar. And again, I don't want to sound alarmist about this. I just want to make investors aware that this is the chess game being played by the smartest and most influential people in the world. And everyone in the world needs to know this information. In fact, that's why 42 Macro exists, is to democratize what we think is the highest level of institutional macro finance. We have clients all across the global buy side that are benefiting from our signals and research. And we want to make sure that I'm doing my part to educate the world and democratize this for retail investors as well. But, if folks can listen, they can listen. If they don't want to listen, they don't want to listen. It's fine with me.
Yeah, it may have been a stat that you put out, but the BRICS countries, the trade amongst and between the BRICS countries went from 30% of their total to 60% of their total.
65%. It's
65
crazy.
In just a few years, right?
Yeah, totally. Now, again, these countries don't trade that much with
That's
each other.
right. As a percent of total, it's still relatively small. But what it is, it's a definite signal that they are increasingly able to be independent and not suffer the problems that the U.S. dollar's regime can impose on them.
100%. And I got two charts to sort of follow up on that, Bob. And
Great.
so you are spot on. The world is way too long dollars in so many forms and facets. And the likelihood that we can carry on with this ridiculously egregious degree of populist fiscal policy with this starting point as the U.S. dollar share of world total, in our opinion, that is a big, big risk to investors if they're not aware of the monetary policy response that's going to come on the other side of the world, increasingly eschewing dollars. So kind of walk you through this chart. So this is, again, dollar share of world total from all these major categories. If you look at the dollar as an anchor currency for all the currencies that have currency pegs in the world, it's 50% of those by GDP terms. It's 60% of global FX reserves. It's 60% of global cross-border bank lending. It's $70% of international debt securities. It's 79% of trade invoicing globally. It's 88% of foreign exchange transactions globally, and it's 99% of stablecoin backing globally. So in our opinion, all of these numbers are going down over the long term, primarily because the rest of the world is realizing, for a variety of reasons, not the least of which are things like sanctions and overreach of U.S. Fiscal and monetary authority or geopolitical authority, and things like profligate fiscal policy. These numbers are going to go down. It's just really at the speed. With the real question as it relates to investors and what's really going to dictate financial markets over the next decade plus is what is the speed with which these numbers decline. So that, in my opinion, is a big thing we need to figure out as investors. But the one of the big things we've already know as investors as it relates to the financial repression and monetary debasement we are likely to continue to see is that the foreign central banks, which is the black line in this chart, the black line in this chart represents foreign central banks exposure to the marketable treasury market, which is currently all the way down at 14% from having peaked at 40% back in 2008. We just don't see how this number can sustainably or credibly go up very much over time in the context of what you and I are talking about, Bob, with respect to the BRICS pack and countries around the world realizing that this system doesn't work for them. And that's kind of the key takeaway here. And that's really the key takeaway for the fourth turning broadly, is that everyone wakes up and realizes that the system that is currently, all the institutions that are currently constructed and with all their largesse and their bureaucracy and preference for this group over that group, it's not working for the average person or the average country anymore. And there will be change, and we're going to get it.
We both know about Bitcoin, and it does eventually, more and more people will be migrating towards it because it cannot be controlled by anybody. You have El Salvador as the first example of a country that decided to try out that as their native currency. The jury's still out, although Bitcoin is up a lot since they started. If it continues to rise, I think we might wind up getting a lot of other people willing to experiment the way El Salvador did. Mm-hmm. Is this too far out in the future to think about as an alternative for countries that want to exit this dollar-based system?
I think it's too far of an alternative from the perspective of the using it as a currency or a form of settlement payments. A form of payment, yeah. I mean, it's obviously one, the energy costs are too great for that. Number two, it's too volatile of an asset for that. You can't have your unit of pricing, change, 10-15% in a matter of a week. That's not,
or 100% in a matter of a year.
100% in a matter of a year. Obviously, you don't want to be on the wrong side of that, obviously, as an exporter importer. So that's the key takeaway, is that it's very unlikely we ever see Bitcoin widely adopted or mass adopted as a currency, as a unit of settling a trade.
I totally agree.
Payments.
Yeah, I don't think of that. I think of gold as a reserve, as a similar 100%. Asset and property.
Exactly. We tried that already. We know it doesn't work. We tried that already. We know that gold itself is not a great currency either, but it is a great store of value for when there is currency debasement. And that's exactly the case we're arguing with respect to Bitcoin.
And historically, central banks have found some safety in having some amount of it on their balance sheet.
100%. I think we're going to see a lot more central banks adopting the Bitcoin standard on their balance sheet. I mean, MicroStrategy, say what you want about Michael Saylor, the guy, he's obviously out there, but he's a very bright person. You don't become a billionaire on accident, by the way. So you have to give your tip your cap to him, which I very much do here at 42 Macro. I think he is doing something, the financial engineering he's doing with respect to Bitcoin on his balance sheet. That's the kind of thing that could be mass adopted for a lot of countries in the world. It's just, okay, we understand that there's a structural geopolitical bid for gold amongst world central banks, and that should be the case. We would expect that to persist. And ultimately, we're going to see not just a structural geopolitical bid for gold. We're going to see investors in the U.S., investors in Europe, investors in South America, investors all around the world going, I don't really want any more of these bond things. These feel like, borrow a phrase from our friend Luke Roman, who says those bonds or treasury bonds are certificates of confiscation. People are going to wake up one by one, and I think we're already I think that process has already begun, at least with the smartest money in the room, of saying, I really don't want these securities. They're not appropriately pricing inflation risks. They're not appropriately pricing supply risks. They're not appropriately pricing economic risks as a function of all that. So I'm not sure that this is an asset class that feels like I should be long at this price level, right? If treasury bond yields went to 10%, I back the truck up, hand over fist. You can't buy enough of them. But right now, they're not yielding a level that is consistent with the upside supply risk that we see as a function of the forward turning, which we can talk about after this, or the upside inflation risk we see as a function of the forward turning.
Well, I'm very curious. You just said 10% back up the truck. Why would you think that there is a price at any level?
Yeah.
Because we know that the debasement is going to be almost a permanent fixture unless we declare bankruptcy at some, unless there's going to be a big default at some point, which
There won't be.
power regimes
Yeah,
don't
they don't default.
historically ever do.
If you print your own currency, you never default.
No, there's no reason. People get much more irritated much faster with you as a leader if you're going to choose the path
Well,
of default over the path of slow debasement.
well, I'll say it a different way. Default makes you no longer the leader.
Yes,
Debasement,
exactly.
you can maintain your leadership. You have a bunch of pissed off people who aren't eating well and aren't living.
Often in a very extreme fashion.
Yeah,
The,
well,
the
look, I mean,
departure
one
of
of my
power.
totally. Folks who want more book recommendations from me, Ages of Discord by Peter Turchin talks about how inflation has historically been used as the tool, going back thousands of years, to to ward off these kinds of political issues, whether it be too much debt or too much infighting or whatever. Inflation has always been the path forward, and ultimately it always ends with the society toppling, or at least the societies that have toppled historically have always had significant bursts and bouts of inflation. So that is a risk here, but again, we don't see that as the most likely outcome. I'm very pro USA. I don't wear a red tie, I don't wear a blue tie, I wear a purple tie as a function of my love for this country and what it's done for me and my family. So I believe we're going to survive this overturning. I do believe it's going to require some very deft risk management at certain critical intervals to risk manage what could be some very potentially steep, painful drawdowns if we ever get into these air pockets again, like what we saw in COVID, which is you're not moving fast enough, Federal Reserve, to absorb the growth rate of these treasuries. There will be air pockets where the growth rate of treasuries is significantly faster than the growth rate of the Federal Reserve's balance sheet and their interest rate policy. And that will cause significant drawdowns from some very high valuations in asset markets that you need to risk manage. And that's exactly what our firm is set up to do, which is keep you long when we're in the bull market, but start to take down risk when you're heading into bear markets and ultimately get back invested once the bear market bottom is confirmed.
Right. And as you pointed out, having a structural outlook over the long term that says the dollar is going to be base and you need to know that in your investment strategy is completely different than making money the whole way, where you're
Yeah.
going to need to go, lean in at the moment at times when it's likely to accelerate and be cautious and move
Oh,
into
yeah.
different assets when things cyclically are looking down. I mean, what do your models tell you? What are the variables that they're monitoring that enable you to turn bearish without predicting them changing? But the main thing would be inflation and growth declining, or some reason to think the policy is going to change. The policy remedy will not show up. Is that
I
right?
like I said earlier at the beginning of the presentation, everything I say about growth, inflation, policy, liquidity is purely to help our clients emotionally prepare for regime change so that when regime change occurs, they're confident making the appropriate asset allocation and portfolio construction pivots in their portfolio. How we help them identify and position for the market regime, however, is a function of our three models. The global macro risk matrix helps them identify the market regime, which I'll walk through in a second. Our KISS portfolio construction process keeps our retail investor clients participating in bull markets and risk managing bear markets. And our Dr. Discretionary Risk Management Overlay, aka Dr. Mo, helps our buy side clients participate in bull markets in the right factors and participate and avoid bear markets, sort of by being in the right factors as well. So I'll give you a quick rundown on how our global macro risk matrix works because it's quite a bit different in terms of how the average macro person approaches financial market risk. The average macro person, by definition, if you sit in a seat and you do what I do for a living, which is tell other people what to do in their portfolios, you naturally have a certain level of hubris that is hard to makes it hard for you to listen to the market. Fortuitously, I've been doing this for long enough and had enough battle scars to know that that is a fool's errand. The market will always be smarter than all of us as individual investors, including us quote unquote macro gurus out there, selling our research insights. So how this model works is we are scoring 42 of the most important markets in the world through the lens of equities, volatility, commodities, currencies, and fixed income through the lens of our volatility adjusted momentum signal. And they were scoring on a daily basis each volatility adjusted momentum signal relative to how the asset has historically performed in any one of those regimes that we've highlighted here. And so at any given time, we can tally up the regime, the total amount of signal that's, sort of being ascribed to any one of the regimes. And then we'll determine that the regime that has the highest share of the total i.e. the regime that has the most support from global financial markets at the current juncture, that's the market regime that you need to position your portfolio for from a factor long short perspective or an asset allocation perspective. And so we dispassionately change our recommendations on different factors, going from max long this to max short that, or half long this to half short that, or max long this to no position in that. We dispassionately change those views whenever our market regime nowcasting process changes, which historically has only had a meaningful change roughly 2.5 to 3 times per year. So, that's a long-winded way of saying only about 2.5 to 3 times per year do you need to do something materially different in your portfolio from an asset allocation perspective or a portfolio construction perspective, which means, let's say we're heading into a 10% correction. You got to take down some risk heading into 10% correction so you can have money to buy the dip with to get back invested, for the next, bull run after that correction. That's from an asset allocation perspective. From a portfolio construction perspective, let's say in that 10% correction, factor leadership flip from pro-cyclical leadership to defensive leadership. That's something that could potentially get you fired as a buy-sider if you are on the wrong side of, particularly with leverage, obviously, as most of the large market neutral players are operating with. So, we're really proud of the system we built. It's not as simple as I'm going to be irresponsibly long Bitcoin and suffer 90% drawdowns every couple of years. But obviously that in our opinion is not the best solution in terms of helping clients, get closer to a comfortable retirement. In our opinion, we think you need to be avoiding those drawdowns.
Well, and this is significantly different. I've worked with many strategists through my career in the equity business, and this is a totally different approach. As I mentioned,
I'll tell you that it sounds different than what you see on the sell side, but everything we do at 42 Macro is just a function of what I think our smartest buy side clients are doing.
Yes.
I've spent the last 15 years flying around global Wall Street, going, "Oh my God, that's brilliant! I got to do that.
I
Oh my
know.
God, that's brilliant! I got to do that.
Well,
Oh my God,
Darius, we attended a conference on innovators or innovation a month ago or so.
Yes, we did.
And what was your big takeaway? We'll compare notes.
So I took about 25 pages of notes in the span of like 6 or 7 hours. So obviously I learned a lot from that conference. The number one thing I would say I take away from that is the path to success is very nonlinear. I think it's very easy when you start a business or when you set out to develop an investment product. Anytime you start something big, we have this natural sort of optimism bias that it's going to be a linear ride forward to the finish line. It rarely has been, and we saw a lot of very very successful entrepreneurs present at that conference, and kind of the underlying message that I got from them was two things. One, the path to success is not linear. You're going to have to make several pivots. You might hit some gut check times at that moment, so you got to hang in there and really believe in what you're doing. And then number two, be authentic. Both as a business builder with your own team, but also authentic with how you interact with the rest of the world. At the end of the day, in this increasing AI era, you're not going to be able to get Darius Dale with AI. But actually, I take that back. I'm sure some of our clients is going to create an AI version of me at some point. But being authentic is something that's going to help you survive the AI era, because it certainly has helped a lot of those very successful entrepreneurs. How about you, Bob?
My biggest takeaway was from a single presentation of a gentleman who exemplified what you just talked about. He started a business. He had 20 people, 19 employees in him, and he failed to get funding and had to shrink the company down to him. He actually got rid of the 19 other people. And then he realized that he needed some extra help, and rather than hiring people, he started outsourcing. And lo and behold, before you know it, he has a couple hundred outsourced engineers. And now he realizes that AI can do all the coding that these people are doing for him, and that he's informing them all that he's not going to be needing them anymore. And so my takeaway is the technology and productivity improvement that looms, if you are on the cutting edge of this, is going to knock your socks off, and that our economy has a whole leg up the way PCs offered the US economy. We have a whole nother leg up, and it's been decades since we've had a technology like this. And there are lots of things that can go wrong, and it's not certain yet, but that was the one mark.
I'm really glad you shared that, because it's something that I feel like we've been this sort of the rejiggering, if you will, for lack of a better word, of the economy is something that I have a lot of faith in. We have what I would consider to be 8 full-time employees, but only 5 of them are actually full-time employees. The other, what I would consider to be full-time employees, each run their own business as independent contractors that plug into us. And so, I think about where the world's going to go in the next 10, 20 years as developers get quote unquote laid off. You're going to have developers starting their own businesses, creating solutions for clients. It's everyone's so concerned about the mass layoffs from the AI, but what I'm very bullish on as a business owner and American innovator here is you're going to have folks like me break off or get fired from the mothership and create better solutions for their customers than they otherwise would have at these, boring, slow legacy players. And that's exactly what we did here at 42 Macro, and I'm really grateful for that.
The amount of leverage that every individual person now has over their ability to express themselves in whatever direction of business and expertise is going to be phenomenal. I think that it's very healthy for the economy to have millions of more startups than we did a generation ago. It's just much
100%.
healthier.
100%.
Darius Dale, thank you so much for joining me. It's been terrific seeing you again, and I look forward to running into you soon.
I appreciate you, man. Hard to miss. Left tackle, hard to miss. Well, I appreciate you having me again, Bob. God bless you guys, and we'll be in touch.
Take care, Darius.
Cheers, brother.
Hey, if you like this clip, please hit the subscribe button. You might also want to check out some of the clips I've posted with my many other guests. My interviews all address the simple question, how screwed are we? We ask experts about the problems that make Americans so pessimistic today, but we also explore why there's never been a better time to have been born than today. Join us for perspective on today's challenges and opportunities.